It's not the tariffs. It's not the collapsing dollar. And it's definitely not the economy. The real reason most people never build wealth, especially during a crisis, is psychological. It's what happens in your head when the headlines scream fear. When markets drop. When the crowd panics. That's where your fortune is either built or destroyed. Because here's the truth no one tells you: most people don't lose money because of external events. They lose because their own brain hijacks them. Fear, doubt, hesitation, and herd mentality take over. The biggest threat to your wealth isn't the Federal Reserve or China's next move, it's your reaction to them. And right now, as the world spins through economic uncertainty, the gap between those who act emotionally and those who act strategically is exploding. The rich are not more informed. They're just less impulsive. They know how to override their biases, while the average person follows them like a script. So let's break it all down. These are the 7 hidden psychological traps that sabotage your wealth and how you can break free before the next financial panic steals your future. 1. Loss aversion: why you fear losing more than you love winning. Imagine this: you invest $1,000 and it grows to $1,500. You feel good briefly. But if that same $1,000 drops to $500, you'll feel devastated. Studies by Nobel laureates Daniel Kahneman and Amos Tversky show that losses hurt twice as much as gains feel good. This is known as loss aversion, and it's one of the most dangerous biases for investors. Why? Because it convinces you to act out of fear rather than logic. It makes you sell at the bottom, hoard cash during bull runs, and hesitate when opportunities knock. And in moments of economic panic, like now, it amplifies every emotion. Your brain isn't wired to seek rational returns. It's wired to avoid pain, even if it costs you fortune. Think back to 2008. While the world collapsed, a small group of investors made billions because they were willing to lose temporarily in order to win big later. Warren Buffett famously bought when everyone else was fearful. Meanwhile, millions sold off their 401(k)s, locked in their losses, and missed the historic rebound. The same pattern repeats every cycle. In 2020, during the COVID crash, the S&P 500 dropped 34% in weeks. Many fled the market. But those who held or bought made back their losses, and more, within months. The difference wasn't timing. It was emotional tolerance. Those who could sit with fear reaped the rewards. Those who couldn't paid dearly for their panic. Now picture yourself today. What assets are you avoiding because you're afraid to lose? What opportunities are you letting pass because of a temporary dip or scary headline? Imagine you invest in a real estate fund while everyone else waits. Or you buy stock in a strong company while the media screams collapse. In 5 years, you could be sitting on life-changing returns. But only if you understand this: the pain of losing isn't the enemy. Acting on that pain is. If you want to build real wealth, you must train yourself to endure discomfort and move anyway. The winners aren't braver. They're just better at ignoring their scared inner voice. 2. Herd mentality: why you follow the crowd into financial traps. There's something comforting about doing what everyone else is doing, especially in uncertain times. But comfort is the enemy of wealth. Herd mentality is the psychological trap where people mimic the actions of a larger group, regardless of logic or evidence. You see others buying a stock? You jump in. You see people selling during a dip? You follow. It feels safe. But historically, it's deadly for your finances. Think of the dot-com bubble, the housing crash of 2008, or the crypto hype of 2021. In every case, masses of people rushed in and masses of people got burned. Not because the assets were inherently bad, but because the timing was emotional, not strategic. Let's go back to GameStop in 2021. The stock exploded because of Reddit-fueled momentum. Millions of retail investors jumped in, thinking they'd ride the wave. Some made money, most didn't. Why? Because they followed hype, not fundamentals. Herd thinking is powerful because it silences your critical voice. You stop asking, "Is this smart?" and start thinking, "If everyone's doing it, it must work." But crowds don't build wealth. crowds chase it. And in moments of crisis, like economic downturns or market collapses, the herd runs toward fear or greed with equal blindness. If you follow them, you inherit their fate, panic, regret, and missed opportunity. Now imagine doing the opposite. While the crowd hoards cash, you invest in undervalued assets. While they jump from trend to trend, you stick to a long-term plan. In 2008, those who ignored the herd and bought real estate in depressed markets saw their investments triple. In 2020, investors who purchased airline stocks or travel ETFs during the lockdown were rewarded within 18 months. You don't need perfect timing. You need independent thinking. Next time you feel the urge to copy the masses, stop. Breathe. Ask yourself, am I following because it's smart, or because I'm scared to stand alone? Your wealth depends on that answer. 3. Short-term thinking, how instant gratification destroys long-term wealth. Your brain doesn't want you to get rich slowly. It wants you to feel good now. That's why you scroll instead of study. Buy instead of invest. Watch instead of build. It's called instant gratification, and it's hardwired into our biology. The limbic system, the emotional part of your brain, is wired to chase dopamine, short-term pleasure. But building wealth requires the opposite. It demands patience, discipline, and sacrifice. That's why so few people do it. They'd rather spend $600 on a new phone today than invest that money and have $50,000 in 20 years. The math isn't hard. The psychology is. In 1972, the Stanford marshmallow experiment showed this clearly. Children who resisted eating one marshmallow immediately were promised two if they waited 15 minutes. The kids who delayed gratification didn't just get more marshmallows, they grew up with better grades, healthier habits, and higher incomes. That same principle applies to your financial life. Think of investing during a market dip, saving instead of upgrading your car, or spending a year learning a new skill instead of chasing weekend distractions. These are marshmallow decisions. They don't feel good in the moment, but they compound over time. Now visualize the alternative. You delay every purchase by 72 hours. You replace 1 hour of scrolling with 1 hour of skill building. You invest $300 per month instead of spending it on subscriptions or gadgets. Within a year, you've saved over $3,600. In 5 years, you've built a side income. In 10, you're free. But none of that happens if you keep trading long-term wealth for short-term comfort. Ask yourself, is what I'm doing right now feeding my future or feeding my impulses? Because the biggest financial mistake you'll ever make is not a bad investment. It's 10 years of good excuses. 4. Confirmation bias, how you only believe what you want to hear. Humans don't seek truth. They seek comfort. That's the root of confirmation bias, the tendency to search for, interpret, and recall information that confirms what you already believe. It feels good to be right. So if you think the market is going to crash, you'll ignore bullish data and watch only videos predicting collapse. If you believe real estate is a scam, you'll dismiss every investor's success story and cling to horror headlines. Confirmation bias doesn't just distort reality, it builds a cage around your financial growth. You stop learning. You stop adapting. And worst of all, you start thinking you're smart for staying stuck. This bias is especially dangerous during crises. During the 2008 collapse, many people consumed only doom and gloom narratives and missed the greatest buying opportunity of a generation. Instead of analyzing actual market conditions, they let YouTube thumbnails and news anchors reinforce their fear. In 2020, during the pandemic crash, those same patterns emerged. People sold their investments too early, refused to re-enter the market, and convinced themselves it was all too risky. Meanwhile, those who studied data, not drama, bought in and watched their portfolios double or triple. It wasn't luck. It was clarity. And clarity starts by challenging your own beliefs. So here's a simple test. When was the last time you intentionally sought out information that contradicted your financial worldview? If you think crypto is dead, have you researched its long-term adoption rates? If you believe the dollar will collapse, have you also studied monetary policy history? Growth starts when you stop trying to be right and start trying to be better. Imagine training yourself to be intellectually flexible, able to pivot based on facts, not feelings. That skill alone could make you rich. Because in a crisis, the most dangerous thing isn't being wrong. It's being certain and unwilling to look again. 5. Recency bias, why the last crisis still haunts you. Recency bias makes you believe that what just happened will keep happening. It warps your perception of risk and opportunity. If the market crashes today, you assume it will crash tomorrow. If you just lost money, you expect more losses. That's why so many people freeze after a downturn. Their decisions aren't based on data, they're based on trauma. But the market doesn't care about your feelings. It runs in cycles, not emotions. Recency bias traps you in fear even as the conditions change. It tells you the pain of yesterday is the reality of tomorrow. And if you believe that, you'll miss the recovery every single time. Look at what happened after the 2008 financial crisis. Stocks were down 50%, home values had collapsed, and fear dominated. Most people backed away. But those who overcame recency bias and acted anyway, who bought S&P 500 ETFs or distressed real estate, became millionaires in the following decade. The exact same pattern played out after COVID-19. In March 2020, markets plunged. Panic was everywhere. But investors who remembered that crashes are followed by rebounds, not endless declines, bought in. By the end of 2021, they were up 100% or more. The key wasn't genius. It was historical perspective. Now fast forward to today. You see rising interest rates, trade tensions, collapsing tech stocks, and your brain screams, it's happening again. But is it? Or is it just your mind stuck in the last bad memory? Imagine if instead of repeating emotional patterns, you trained yourself to zoom out. To look at 10-, 20-, 50-year trends. You'd see that every crisis is followed by a wave of opportunity if you're brave enough to act when things look darkest. Recency bias is a liar. It wants you stuck in yesterday. But wealth is built by those who keep their eyes on what's next. 6. Anchoring, why you can't let go of bad prices. Anchoring is one of the sneakiest ways your brain sabotages your wealth. It happens when you fixate on a number, usually the first one you saw, and treat it as the standard. You saw Bitcoin at $60,000, and now you won't buy it at $35,000 because it used to be higher. Or you bought a stock at $80, and now that it's at $50, you refuse to sell until it gets back. But markets don't care about your reference point. They care about reality. Anchoring makes you emotionally attached to irrelevant prices. It traps you in the past and keeps you from acting strategically in the present. This bias causes two dangerous behaviors: paralysis and poor decision-making. Paralysis happens when you do nothing, waiting endlessly for an asset to return to a mental price instead of responding to what's happening now. Poor decisions happen when you refuse to cut losses or reallocate capital because you're anchored to a past value. During the 2008 crash, countless investors held toxic assets hoping they'd rebound to pre-crash levels. Most never did. And while they waited, new opportunities passed them by. Anchoring doesn't just cost you money, it costs you time. And in investing, time is the most valuable asset you have. Now imagine breaking free. You evaluate investments based on fundamentals, not old prices. You stop asking, is this higher or lower than what I paid? And start asking, is this undervalued or overvalued today? You sell losing assets without shame. You enter promising positions without nostalgia. This is how great investors operate. They're not emotionally attached to price tags, they're focused on potential. You can do the same. Let go of the mental anchors. They're not protecting your money, they're drowning it. And every day you wait for a number that may never return is a day you're missing the numbers that could change your life. 7. The antidote: awareness, discipline, and independent thinking. If your brain is the enemy, then awareness is your shield. The first step to escaping mental sabotage is recognizing it when it happens. When you feel fear rising, ask, is this emotion based on fact or reaction? When everyone's buying the same thing, ask, am I making this decision, or just following noise? Most people don't ask these questions. They move on autopilot, driven by bias, habit, and emotion. But the top 1%? They pause. They reflect. They challenge their instincts. That's what separates the emotional investor from the strategic one. Awareness gives you space to choose, and that space is where wealth is built. Discipline is the next layer. It's the ability to act on logic, not feeling. To invest every month even when the market dips. To hold your plan especially when fear knocks. It's saying no to things that look exciting but break your strategy. This isn't glamorous. No one posts discipline on Instagram. But over time, it crushes every other advantage. A person with average income and high discipline will outperform a high earner with zero control. It's not about being brilliant. It's about being consistent. Imagine setting a 10-year wealth plan and sticking to it no matter what headlines say. That's how fortunes are made. Finally, independent thinking is your ultimate edge. In a world where everyone copies everyone, original thought is rare and powerful. Read what others don't. Ask what others avoid. Invest where others hesitate. That's how Warren Buffett built his empire, by thinking differently, not loudly. Picture yourself 5 years from now. You ignored the herd. You acted with clarity during chaos. You built when others froze. The results? A portfolio that grows. A business that thrives. A mindset that doesn't shake with the next economic tremor. Because you didn't just master markets. You mastered yourself. And that is the greatest financial skill of all. The next recession won't ask for your permission. The next crash won't wait until you feel ready. And the next transfer of wealth won't stop to check if you've healed your mindset. It will simply happen with or without you. Because the market doesn't reward the smartest. It rewards the most emotionally prepared. Every bias you ignore becomes a trap. Every fear you obey becomes a price. And every excuse you repeat becomes a wall between you and the life you want. You don't need to predict the future. You need to protect your behavior. That's where real wealth lives. Not in timing the market, but in training your mind. Because when the headlines turn dark and the crowd panics, you'll either be frozen or free. Free to act when others hesitate. Free to think when others follow. Free to build when others break. So the question isn't will the economy collapse or will the dollar survive? The real question is, will you be ready when it does? Not just financially, but mentally. Because the richest people in the next decade won't be the ones who saw it coming. They'll be the ones who stayed calm while it did.